What's a balance sheet? If you have a business, you should have a balance sheet. A balance sheet is a snapshot of how your business is doing. Put simply, the document shows what your business has, what's been put into it, and what's been taken out of it. As its name suggests, a balance sheet should balance. There are two parts to a balance sheet. Let's look at them individually. So, the first part is a statement of assets, that's what your business has, and liabilities, that's what your business owes. There are different types of assets. Fixed assets are, in loose terms, those items you need to operate your business. So if you own a flower shop, your fixed assets would include your shop, your delivery van, your computer and your display shelves. The other things your business has are classed as current assets. These tend to be very liquid and easily converted into cash. Current assets include stock, the flowers, vases and bouquets in our florist shop for example, the money owed by customers, the cash in the till and any money in the bank. Any short-term investments and prepayments, rent on the shop for instance, are also recorded as current assets. The next section on the balance sheet shows your business's current liabilities. These are what your business owes, or the money it has to pay within the next 12 months. Listed here on the balance sheet will be creditors. These might include outstanding supplier invoices, loans and overdrafts, or hire purchase payments. Businesses may have some long-term liabilities as well. These need to be taken into account when calculating the net assets figure. Our florist may have taken out a bank loan when she started the business and hired storage equipment on a hire purchase scheme. The repayment of these spans more than 1 year, so they are counted as a long-term liability. If you've been paying attention, you should now have some idea of the maths needed to do the first part. To find out what your business has, you need to work with the totals so far. Adding together your fixed assets and your current assets will tell you what your business actually has in its virtual pocket. But then you need to deduct the liabilities. You can't spend the £10,000 in the bank if you have bills of £8,000 due at the end of the month. The total of this sum equals your net assets. That's the first part explained. The second part of the balance sheet simply shows how the net assets have been financed and should detail the money that has gone into the business and the money paid out. Included will be equity, that's the money its owners have put into a business. Retained earnings, that's the profit from previous years held onto to reinvest in the business rather than paying out as dividends or drawings. And current profit, that's what the business has actually made this year. Those figures all need to be added together and then deduct the money paid out in dividends or drawings. That figure should then equal the net assets figure from part 1. It's all a balancing act, one which your accountant or accounts department can work out, but one which you, as the business owner, need to understand. Hopefully now you do.